Hello and welcome to round two review of the Zoom simulation. Before we get started, just remember that we have another round three, which is due on Saturday the 21st. I have graded the latest case studies that you submitted over the weekend, and you can check your grades out online for those case studies. And we have soon, let's see, case 4 will be due Friday on the 20th. And we do have the final exam will be coming up soon. It will open up on July 1st. You got like 2 weeks at least. And July 1st I'll be opening up the final exam, which you'll see under assignments. You can click on here to take the final exam. And that'll open up on July 1st at 6 a.m. and it'll close July 6th at 10 p.m. And the exam, you can download the exam, type it up in a Word document, and attach it to this link for me to review and grade. So that's coming up, and you still have case 4 and 5 to complete, as well as the simulation. So still some work left to do in the class. Not to mention, you should be keeping up with the video lectures each week that I've recorded. And this week we're moving into the Blue Ocean book, and I recorded my lecture on Blue Ocean, as well as a guest lecturer from University of San Diego. No, actually, that's next week. This is actually from one of the authors of the textbook. I have a guest lecture from one of the authors of the Blue Ocean textbook talking about creating new markets. And then next week, in week 5, I have the guest lecturer from the San Diego, California Public University, the University of San Diego. And so this class is finishing pretty quickly. So just want to bring you up to speed on a couple of those things. So let's look how people did in round 2. So these are the profit levels from round 1. You can see that just about every company has exceeded their profits from round 1 going into round 2. And that's a really good thing, because companies are supposed to maximize their shareholders' wealth. And this is one of the things you're supposed to be learning and reinforcing in business school, is that if you're going to run a company, the strategy of the company should lead itself, should end up in the company maximizing its shareholders' wealth, hopefully in the short and long term. So most of the companies have been maximizing their shareholders' wealth. And along with that, the more you maximize your wealth, the higher your profit margins, the higher financial ratios, the more points your company is going to have. Now, most teams did very well in round 1 in collecting their points. Now, round 2, since it's a year-over-year improvement, you did very well in round 1. It's going to be even harder to beat those numbers in round 2. Hence, most people's overall points were lower in round 2 than round 1, but still, if you're coming in around 400, 500 points, you're doing very well. And most teams are between 400 and 500 points, with a few teams exceeding that. So far for the class, people's points are doing well. And if you want to maintain or increase your points moving forward, you have to increase your profit margins and increase your total profits, and that will help to increase all your financial ratios and do very well in your overall points moving forward. If we look at stock price here, we could see some changes here in stock price. Everybody's stock price went up, which is good, and some people had a more steeper slope than others, and that's what you want. Now here's a hint for increasing stock price. If you buy back your stock, that will help to limit the amount of outstanding shares and help your per share variables to be higher, and that winds up increasing your stock price and majority of your points as well. Now, if we look at sales, we had a couple companies here that everybody seems to have increased their sales, but some companies have not increased their sales as much as they could have. And you could see that, this company here moved into first place, and then we have second and third and fourth. So we have some competition. Most companies are up here. If you're in this bottom sales area here, these 3 companies, you have to ask yourself, why am I so far behind in sales? And the answer is your forecasts are wrong, are weak. So you need to go back to the student user guide. It tells you, it projects what the growth in each of the car areas will be every month, and you have to look at your actual versus demand chart from your individual charts to see what actual demand did you generate, and if you underproduced those cars, you limited your sales. Okay, if we look at earnings per share, we could see that this company's earnings per share did very well because they purchased back stock and increased their profits greatly. Most companies did increase their earnings per share. Two companies lost earnings per share. So that's not a good thing. If you're a public company and you announce that your earnings per share are lower than the year before and your profits are lower than the year before, your company is going to get destroyed. So you have to always increase your earnings per share and your profits, and along with that, your sales will increase as well, should be increasing. But sales, it's more important to be profitable than be number one in sales. So let me go and look at, okay, this is my practice demo, and what's important when you're in, this is my year 2 results. What's important is that you have a surplus. Now, one thing that can kill a surplus is having unsold cars, current inventory. So if you don't sell all the cars you're forecasting and plan to sell, those cars that are not sold are not generating the profits that are eventually going to wind up in your surplus. So if you don't sell all the cars that you had planned to sell and you have unsold current inventory, you could wind up with a deficit. See, here I have a surplus of 500,000, but I was planning a surplus of more like 10 million or 15 million. So luckily I had padded my surplus, left 15 or 10 million in my surplus. That way, if I had some unsold cars, I could still manage a surplus. And remember that operational investments are very important too, that every time you double your year-over-year operational investments, you get 100 points. So not making operational investments, you're leaving off an easy 100 points on your score. So that's an easy 100 points most rounds. Now here you could see that my profit ratios increased 40 to 52, 23 to 33, 16 to 22 on gross operational net. So these profit margins are critical. They have to always increase. That's what investors are expecting. And the increase of these profit margins in conjunction with my increase in sales is what develops my additional increase in total profits and net income. And that profits and income helps me to increase my total asset turnover, my equity multiplier, my return on equity, my earnings per share, my return on assets. Just by increasing my profits helps all these profit margins increase and generates a lot of points for me. And also with increasing stock price will increase my market capitalization. And you can see here that my forecast was good, except I had a problem with my sedans. Okay, so you need to interpret your overview points to see where did you lose points, where did you make points. And starting with this current round coming up, I want you to start filling out the reflective observations because I want to see what you're thinking. Now on the industry page, you have a good example here to look and see what all the other companies have done. How did they build their cars? What's their gross profit? What's their market potential? What are their financial ratios? So if you're doing very poorly, look at the company that did very well and see where you differ from them. And this is no different than what happens in the real world, where if one company does very well, the other auto manufacturers want to go and see, well, what did they do that made things so good? Okay, in the charts, an important chart to look at is under your performance charts, you want to look at market versus actual. So this shows me here on truck, I sold 1,750 cars. I could have sold 1,900. On luxury, I only built 1,500 luxury cars. I could have sold 1,700 luxury cars. So here, if I'm going to forecast for next round, I'm going to go off this 1,700 because that's the demand, not what I actually sold. So if you're increasing what you actually sold by 20%, because that's the growth of the market, you're going to always be behind. You need to look at what the market potential is and grow that number for your forecast. So here, I under forecast as well. So I'm not going to grow this 2,000. I'm going to grow from the 23. So here I actually met my potential and sold. I had enough cars to meet my potential. Actually, I had more cars. I actually had unsold cars, so that's the danger on the other side. But I'm giving up all these blue areas. The difference between the yellow dot and the top of the blue bar is cars that I'm not selling, I'm giving to other competitors, going back in the general pool, and other competitors who have excess inventory are picking up those vehicles. So that's not a good thing. So now when I go back in, I'm going to redesign my car. But I'm going to be smart. I'm going to go back and say, okay, what was my average profit margin? It was 52 is my average gross profit margin. And since I invested in operational investments, although not that heavily, because you see these, I did 4 levels of operational investments here. Now on my sales page, I have a cost reduction. But you'll also notice that the customer expectations are increasing. Customers are wanting more. Surprise, surprise. So I'm going to build my car. And remember, you can go below customers' expectations or above to a certain level, but you can't go higher than the highest end price. So here I'm going to disappoint on, I'm not going to be able to get above 52 because it's getting tougher to make, maybe I'll go a little bit lower on this. Okay, I got to 50. It's getting tougher to make my profit margins, because customers are expecting more. So this is too low. All right, so I got it above 52. I could get it to probably about 53, so a little bit better. So see here, I'm not making the best car possible, which of course I want to make the best car possible, but sometimes that's not possible if I want to maintain my profit margins and please my investors. Now, if I make a car that, is lower on expectations, I'm going to sell less. So I need to kind of factor that in to my sales as well. And then if I'm going to make a car that's really not as desirable, then I have to really remember that I may not sell as many units. I'm not going to be the most competitive in sales. Okay, so here I was able to increase my profit margins above the 52% for all my vehicles. Remember, starting now, I want you to fill out these reflective observations for the simulation. Okay, now advertising. Kind of skipped over advertising. It's a little bit more detailed. It takes longer to break that out. So I'm going to go right to production, and I'm going to have to buy a new plant here. I'm only going to build. You never want to build more excess or shortage. You always want 0 here, because why would you? If you think you're going to sell more, then forecast more. Okay, so here I'm going to have to buy another plant, and I'm going to double. I'm going to put in 4 levels so I can double and get the 100 points of my operational investments. And again, there's reflective observations on this page you will have to fill out. And let me go right to the bottom, and I see that I have a $40 million surplus, which is good. So I'm going to go and I'm going to buy back some stock that I had issued earlier. All right. So I guess there's a limit on how much I can buy back. Okay, so I'm going to buy $10 million back. I'll buy back some other funds to lower my debt. Okay, so now I have 27, still large, but you know what I can do? I'm going to leave it at that. And I'm just going to submit my results, and you'll see that 646 points. I'm happy with that. It's above 4 and 500, sort of the average. So if I can get above 500, I did very well. Now I'm in round 3, and you just kind of keep moving forward from here. I got my profit margins from 52 up to 58, and now I'm going to try to move it up to maybe 64 if I can. You'll notice that in the sales area, now my cost reductions are 2,400 because of my operational investments I had made. So it's really key to do that to do better. Okay, so that's my quick review of the simulation. the class is doing well, the simulation continue to do well. And remember, you have the individual practice that you can still work with. If you want to reset the individual practice and try a couple of rounds and try some ideas, this is where it all comes together from all your MBA education, accounting, finance, marketing, operations management. This is tying all these concepts together in you leading a company. So by not really, if you're doing poorly in the simulation, you haven't really integrated a lot of these lessons together from all these classes. And that's why we're giving the opportunity in the strategic management class to tie everything together and run a company and have it perform. And people run companies to make money, not to make, people don't run companies to make the best product at the lowest price for customers. That's the marketing that they, in advertising, they try to make you believe. So if you believe that companies are making the best products, the lowest prices for me, you are brainwashed. Companies, of course, they want you to think that, but what companies are doing is they're making the cars that hopefully meet most of your expectations, but they're doing it in a way to maximize profits, whether that's outsourcing, getting cheaper components, redesigning, re-engineering, redesigning the factory floor, more robotics, better software, whatever they can do to lower costs, because customers, stockholders and investors expect a return, and they have to maximize their shareholders' wealth and increase their profit margins, increase their sales, increase their earnings per share. This is what's expected. And if you look at any stock out there in the stock market and you notice earnings release, if the earnings release come out and they disappoint on the top line or the bottom line, that's just fancy words for if they don't increase their sales and increase their profits and increase their earnings per share, the stock gets decimated, because that is what the name of the game is. Okay, so that's it for this quick review. I hope you find this helpful, and good luck in the next round.